Hey everybody, happy Thursday, July 13th. It's about 11:20 on the West Coast and it's time for another market updates. Last time I updated you guys, it was a bad day. The ADP job report had come out. It was way more than expected, more than twice what was expected. We were coming off the Fed minutes that showed they still wanted a hike. And the next day was going to be the BLS jobs report, which had been going really bad for us the last couple months. So, things looked pretty dire. But things actually took a nice turnaround since I last spoke to you. So let's get into that. So the first thing we got was that May BLS jobs report last Friday. So it came in at 209,000 jobs created, 240,000 were expected, but unemployment did fall from 3.7 to 3.6. So let's take a little closer look at those numbers. So like I said, 209 compared to 240, they actually made negative revisions of 110,000 jobs the previous 2 months, which made those reports weaker, which I talked about before is awfully convenient. It seems like that happens quite a bit. One thing to point out, leisure and hospitality dropped off, not as much. ADP, this was a huge number. BLS, not as big of a number. Government and healthcare were bigger numbers, but those are always going to be happening no matter what's going on in the economy. And things that hurt it a little bit, average hours ticked up, which means that hurt things a little bit, and the average weekly earnings ticked up a little bit, and that was kind of a little bit of a negative. But taking a little closer look at the household survey where they get the unemployment number from, and that dropped. That people saw that, and it was a little bit of a negative. There's 273,000 jobs created, and like I said, unemployment dropped from 3.7 to 3.6. But the all-in number, the U6, which counts people that maybe took a job but would rather have a different job, a longer-term job, that actually went up from 6.7 to 6.9. And then multiple job holders went up 233,000. Part-time for economic reasons went up 452,000. Could only find part-time, we're up 122,000. So if you just do some quick math and subtract this 452 to the 273, that means 180,000 full-time jobs were lost. So, this doesn't look as strong as things, are a lot of talking heads. The Fed is making things look. This looks like a lot of people are getting jobs because they have to. They're taking second jobs because that's the only thing they can find, part-time work, things like that. So, the market reacted pretty positively to this, kind of throughout the day, it was kind of up and down. The next thing we got was a couple of days ago, the June CPI. This was a really big one. This is inflation. This beat expectations across the board. So this was very important for us in the industry. It's kind of been delayed with a couple of things like the debt ceiling issue and the bank issues. But this came in at plus 0.2, both the core and the headline, when plus 0.3 was expected. Again, take a little closer look at these numbers. So, we got some help from used cars. Used cars were finally down 0.5, but like we talked about, things like the Manheim index are showing it down a lot more than that. And this is lagging. So we should expect more help there. And then down here, shelter is still a big issue. 43.5% of the core, it's coming down 7.8 from 8, but it's still high. It's still elevated. And as we know, shelter costs are lagging. So if we can kind of see here, the aggregate from all these different core logic stuff, it's down to 3.7, where the CPI number is at 7.8 now. So we can see it's crested and it's starting to come down. But the what's going on in real time is that's been happening for a while. When we go back in time, we can see when this started going up at first, this was still going down. So there is a lag between that. So we can expect some more help in the future, with that coming down. Next thing we got was June PPI. This was today. This is the producer price index. So this is inflation on the producer side. This beat expectations quite a bit too. It's the lowest year over year. It's down to plus 0.1%. It's the lowest since August of 2020. And the reason this is important is these costs tend to get passed on to us as consumers. So this is usually a forward-looking indicator. So the CPI is looking at what we actually spend. The PPI is looking at what cost to, create the goods that we spend this money on. So, if this is going down, as accelerating going down, then that should bode well for consumer stuff in the future. So really good inflation data the last couple of days, which was very well needed. Like we talked about, the Fed's been looking at jobs and inflation, and this BLS job number coming in lower than expected, and this inflation number is coming better than expected. That's all positive for us looking at mortgage rates. Initial job claims actually came today, plus 237,000 when 249,000 were expected. So if not for that, we'd even be having a better day than we are right now. But still pretty close. And one thing to keep in mind, this was a holiday week. 4th of July was on Tuesday of that week, so it's a weird week. A lot of people probably didn't even, that were going to apply for employment, maybe wait till Wednesday. Maybe they're having a good time on the holiday. So that number coming in lower is not that big of a shock. So maybe we'll see, when we get next week's numbers, maybe that number is going to be a little bit higher than expected because of that holiday week. Let's see. What else did we get? Purchase apps. Purchase apps were up 2%, still down 26% over year. If we keep getting these positive gains, maybe we see these numbers go up. Oh, I'm sorry. Miscellaneous home prices gains continue. So let's take a quick look at this chart. So like we keep showing, across the board, Case-Shiller, FHFA, CoreLogic, Black Knight, and Zillow all show home prices turning higher. Accelerating, 3 of these, FHFA, Black Knight, and Zillow, all show all-time high readings in real estate values. So, this is good for current homeowners. Not good for people wanting to get in the market, good for current homeowners. A little different than what people were expecting as far as prices going down. Obviously, the lack of inventory is affecting this. So, so far, so good for current homeowners and great for them. But good for the real estate industry as far as that goes. And then where does that leave us? The average 30-year conventional is down to, let's say, 6.9. They actually haven't updated today. It's at 6.96, but today, again, is a really positive day. If anything, I'm being conservative. That's probably lower than that, but it's down from 7.22 last week. So we dropped at least 0.32 or so, which is a great drop. We need that to continue. It'd be great to get down in the mid-6s, low-6s again. But this is a step in the right direction. The problem, which we'll get into right here, is the next real big data we have besides unemployment claims and some different reports like that is the Fed meeting on July 26th. Even with all this positive data, the markets are still showing a 95% chance that the Fed's going to hike. The Fed's going to hike. We're basically, that's what's going to happen. Unless a miracle happens, the Fed's going to hike again. The couple days after that, we get PCE. That's going to be the follow-up to the CPI. So it's the same data they're looking at. So we should probably get a good report, but it's going to get 2 days too late. And then we get into the job reports and the next CPI. But, really, where we go from now, the super optimistic, we get a miracle thing happens, is they don't hike, the markets go crazy, rates come down. The more likely what's going to happen, but still optimistic scenario is they're going to hike again for 25 bips, but all this data keeps, coming in and they don't hike again. They've said they want to hike twice, but this is going to be the last hike. That's the realistic optimistic we should shoot for. And then the negative would be they hike twice more like they've, said they want to, and more bad things happen and they hike even more than that. So let's ignore that and just hope that doesn't happen and cross our fingers. But that's all I have for you guys. Like I said, great week. It's a lot funner to tell you guys rates drop by 0.32 compared to rates going up by a quarter of a point, which things it seems like each week that's been happening. So if anything needs anything at all, please don't hesitate to reach out. Hang in there. Like I said, rates are coming down. Maybe that sparks more activity, more people willing to list because they want to buy another home. So hang in there. Things are going to get better. Have a great day, everybody.